What's up everyone, welcome to the channel. My name is Opie. I'm a senior animator in the video games industry. I wanted to touch on investing for artists because, growing up in school, we weren't taught financial literacy. Especially, I went to state school, so we weren't taught that. But obviously, if you went to private school, yes, we are taught everything in private school, right? But state schools weren't designed like that, right? State schools were designed to put you in a box, take orders, go out into factory, and do some work. But what I want to share today is investing, and I wanted to share what I've learned through these great books right here. I'll show you these. They will all be up here on the video somewhere. But classic, Rich Dad, Poor Dad. You've got Peter Lynch, One Up on Wall Street. Great. I'll be using a lot of his references. Psychology of Money. You've got The Millionaire Next Door. These are all great books. Links will be in the description. Fastlane Millionaire and The 1 Minute Millionaire. And of course, I'm reading this book at the moment, Warren Buffett, Snowball. And I've just, started at 10 pages, that's it. But this is going to be a bit longer for me to finish. So this video is going to be an accumulation of what I've learned in these books and basically what I've learned from people on YouTube as well and everywhere, and how I have created a portfolio of passive investment. I'll go through some work pensions and stuff, especially in video games. When I was working in the States, it was the 401k, and here the pension in the UK is different. But I'll go through my pension and I'll go through what I've set up for my daughter who's 3 years old now, and just for her future, and something that you could also do as well. Obviously, I'm not a financial advisor. I'm still learning about this stuff. So if you're interested and serious about investing, go seek financial advice first, and you can kind of use this as a guide, but make sure you get financial advice. So from my experience working in video games in specific, but I'm sure this is all across the board, a lot of my friends would be asking about investment and pensions and what to do. And I was unclear too. So I wanted to do a bit of research and self-educate myself reading these books that I just mentioned. And in this video, I will share where I have invested my money and also my Warner Brothers pension pot when I used to work for Warner Brothers. I'll show you that as well, and how the funds are doing since I've left the company, and what common investment recommendation and methods I use for us everyday normal people and artists. I say artists, but really it's everyone. This video will be in 3 sections, and I'll put timestamps so you can skip if you want to. So the first one will be introduction to investing, which stocks to invest in. And number 3 is the doubt, uncertainty, and fear that we have when we invest. Okay, everyone. So you may be wondering, what's the point in investing? Now, this famous book, Rich Dad, Poor Dad, Robert Kiyosaki says, the rich don't work for money, meaning that they build assets and they have the assets create the cash flow. So in this same book, you learn about the difference between an asset and a liability, right? A liability is something like, for example, I have a mortgage. To me, that's a liability because it's coming out of my paycheck. But then you have assets. So, my wife and I have a couple of properties and they're bringing in cash flow. So that's good debt. It's not bad debt. So bad debt is like a mortgage, and a good debt is like assets that you buy, but you're not paying for it. The tenants are basically paying for the mortgage. So that's basically the gist of it. You have assets and liabilities. Now, the main aim is, for example, say if you're working at a company and you're making, between 2,000 to 4,000 a month. You want to build assets that will replace that income. A steady cash flow is what you want. So you can leave your job and you are free of your time. That's what you're doing. Because what we're doing now, really, when I read the Psychology of Money by Morgan Housel, is saying you're exchanging your time for money. You're working for somebody else's dream. Now, what you want to do, you want to basically get those assets, like I said, that replace your income so that you can leave your job and start doing what you want to do. You're getting your time back, and essentially that's what you're doing, so you can work on your dream. So the main thing here is trying to get a steady cash flow. Now, there's a few ways you can do that, right? There's property comes to mind first. Then you have digital products that you can do. For example, here, there's a course I've created for mastering animation, video games and animation. So, you can create digital assets like that. There's YouTube videos as well that you can do. You can monetize and make money that way. So you can create different streams of income. They say the average millionaire has 6 to 7 streams of income, businesses. But then, of course, you also have crypto, you have ETFs, index, which we'll get into. You have government bond, gilts, which also give you a return, and arts. Obviously, being an artist myself, you can invest in art, fine art. And then there's NFTs as well. There's a video game I'm working at the moment. They're dealing with NFTs. You can also do that too. So I will share with you what I have done, because that's all I've researched. And then maybe in the future, I might do my due diligence and research and then do another video on investment too. So let's dive in. So when you buy a stock, you got to understand that you're buying a share of a company. Now, there are 2 ways of making money with shares. One is that you wait patiently and just let the shares build up and compound. And the other way is dividends, which is basically a company has a profit pot or pool of cash and they pay their investors every quarterly, sometimes monthly or quarterly, right? You get a dividend, you get a payout. Now, obviously, if you own 20% of a company, you're going to get a massive payout. But for people like us, everyday people who are investing, it's not we were not going to really put that much money in because we are probably not aware of how this works, the system works. So putting all your eggs in one basket might not be a good idea because we can't predict or beat the market. It's kind of a gamble putting all your money into one stock. Unless you're a professional, FX trader. I recently finished reading a book by Gary Stevenson called The Trader's Game. And it's a brilliant book. Check that out. And he was a professional stockbroker, trader. So he knew what he was doing. He was making millions, You can check his book out. It's a great book, great read, great memoir of his time as a trader at Canary Wharf. However, if you want to pick individual stocks, there's a great book called One Up on Wall Street. He talks about individual stocks, but also ETFs and index funds as well. But Peter Lynch, he just gives you an idea of when you're picking stocks, what to do. It's like, for example, it's like going shopping, right? You go on Amazon. What do you do first? You check out the reviews. You check out the background. You check out the description. What is the company about? What is the product about, right? It's the same thing with a company. What's the market cap? The little terminology I do know, there's a market. What's the market cap? How many people are employed there? What's the turnover? How long has a company been around? So there are all these little things that you got to consider before you really invest in a company. And also, is it something that you can stick for in the long term, the long road? Now, what should we do if individual stocks are a bit riskier? Well, there's a thing called ETF index funds. You're probably wondering now, what is an ETF fund? Now, basically what ETF index fund is, and what I will be explaining to you is what I've invested in for my daughter is the S&P 500. So the S&P 500 is a collection of the top 500 companies in the States. Now, there's loads of others. There's emerging markets. There's FTSE 100, which is the UK top 100. Emerging markets is East, Asia, China, and all those areas. So there's all of these groups you get basically. And then you can put money in there and you can put a fixed amount every month. For example, my pension fund for Warner Brothers Discovery, when I looked at it, it's run by Fidelity, and Fidelity Investments is what Peter Lynch was head of, one of the hedge funds there, which he done really well in. He was getting like 30% returns every year. So if we look at the S&P 500 here, this section here tells you the weighting, like which of the amount of percentage is of which area. So information technology, tech sector is 28%, healthcare 13%, financials 12%. So you can see it all here. Utilities, real estate, right? The percentage that's allocated. Obviously tech is massive at the moment. So, but then if you come down to the holdings, so if you look at the holdings of Apple has 7.5% in there. Microsoft 6.5%, Amazon 3%, and Nvidia, like we said, 2 points, still a lot. Alphabet as well, Google, Tesla, Alphabet C, Berkshire Hathaway, that's Warren Buffett's company, Meta, Facebook, and United Health. So top 10, ExxonMobil as well, they're massive as well, massive empire. But a lot of these 1%, then you start coming down, Procter & Gamble, MasterCard at 0.92%. They're still valid, but they don't produce enough. It's big players at the top. The other 500s, I haven't even heard of those companies. It's normally the top 10, 20 that are kind of keeping the group afloat, right? If it kind of, they're the main players. So that's basically, it's a safe bet, S&P 500, right? If one company doesn't do well, another one will probably compensate for it. That's why you go into these index funds and kind of diversify your income, which I'll get onto later. But basically, when you put money into this S&P index fund, the index spreads it out. Yeah, it might put 7% in Apple of your money, or it might put 6% into Microsoft. It spreads out your wealth. It spreads out your money, and it calculates itself where is best to invest. So it's very good system like that. It's kind of diversified, so it's a bit less riskier for you to lose all your money. But then going back, like so for example, come back to Google Finance. These are some of the stocks I've been looking at. So Nvidia, Games Workshop, I paint a lot of miniatures, so I invest in Games Workshop. Nvidia, of course, Alphabet, Google, Apple, Electronic Arts, Walt Disney. So you also notice that I'm investing in companies that is in an area which I know, right? Video games. It's massive industries, billions of dollar industry. But I know about the industry, I know how it works. So this is one thing Peter Lynch was saying as well, it's good to invest in stuff that you're familiar with too, and you're kind of excited about, because you will follow it. You will follow the trend. You will follow the company. What's it doing? You know, is it profits up? Is it down? You know, how's it? Did they fire a lot of people? Did they hire a lot of people? The layoffs, stuff like that. So you tend to just keep more on track of it, unless you're a professional guy, right? And you're working. And then also there is an ETF for esports gaming. So let's check that out. So there's VanEck. So this is another one. So this is basically like I'm not going to say it's an S&P 500 equivalent to games. It's not, because there's some companies that are in the S&P, like the EA is in the S&P 500, but their holdings here is basically Tencent, which is a massive Chinese company, NetEase as well. You know, all these companies are very familiar to me. Roblox, Take-Two, Unity. Unity is what I use to make games. So, you know, there's also Tencent also I think they hold like 48 or 50% of Unreal Engine, which is what makes the game. Another software, which is like Unity, but it's massive industry, you know. But yeah, Tencent holds 8%, NetEase 7%, AMD, we all heard of AMD processors, right? Nintendo, you know, these are brands that, you know, even if you're not in the video game industry. Electronic Arts, EA is everywhere. You know, I used to work for EA way back. Namco. Yeah, so you can see the similarities, right? They pick the best, the bigger players, put them in the group, and you can invest in this. So I've got a few in this as well. I'm investing in this as well. And also S&P. So also, if we look at the performance of the S&P from when it started, in 13th April 1984, look at the trend. It's always been going, the overall trend has been going up. It's the same thing as, like, for example, I went on a fitness journey, right? And I was losing weight, but a weight loss doesn't happen linear. It happens a little bit, then it goes up a little bit. You know, you might have some meals, a cheap meal or something, then it goes back, stick to the plan and goes down. But the overall trend is going down, right? So the S&P, I guess you could see it like that. Stock market kind of always goes up, then it goes down, up, you know, with COVID, you know, how that went down, dropped here, 2020, March 2020, it went down. But you can see, look, it goes down, but the market always tends to recover. And there was a big dip here in 2000, obviously in 2008 with the crash. You know, I was living in the States then, I remember that. And then gradually, look, it's going up, and then, of course, COVID hit, went down. Down is always a good time to buy as well when it's low, you know. You just but obviously with S&P, you're just putting in a fixed amount every month anyway. And then, yeah, it's gone up, dipped a bit. Now it's gone up even more now. It's 28 March 2024, it's going up. So this is what I mean about long-term investment, you know. Long-term, you will see that gain happening. And then, you know, you just take the money out at the end when you can see it's on an upward trajectory, you know, like, or whatever, you know. But as you can see, this graph is just to show it, eventually, look, the money does go up, you know. You just have to stick it in and not be too emotionally attached to your money when it's in a fund like this. You just got to let it grow and not think about it. Yeah, I mean, Warren Buffett mentions it too, you know. I don't think he got his billions until he was in his 50s or 60s, I think. But the thing with Warren Buffett is he started investing young, when he was 10 years old or something, his first investment. And he's in his 90s now? So time is money too, you know. He's put the time in, he's waited, he's let the money compounding interest, as they talk about, you know. When you put money in, especially with S&P, if you don't take it out every year, that money is compounding. You get 8% on your first return. Say if you put £100 a month in, that's £1,200 in the year. So say if you get 10% on that, you get £100, right? The next year, you're going to get another 100 a month. You're going to get what? 2,400. You're going to get 10% of that. And as long as you don't keep taking the money out, every year the money is growing, you're going to get more of the percentage, you know, because you've got more money. The more money in there, the better, you know. If you can throw a whole lump sum in there to start with, that's even better. But you can start from scratch too, that's not a problem. So the main thing is start as early as you can and then really try and just put a bit of money in, 10% of your wage. You know, there was a famous story about a UPS driver. I believe Tony Robbins was talking about it, where he was on $17,000 a month and he ended up retiring with, like, he made $1 million or just over $1 million or a few million, I'm not sure, but he had a good point. He said, look, why don't you set aside $200, $300 a month? And he was like, why? That's a lot of money. He goes, yeah, but you don't question $300, $400 of your taxes coming out. So if you see it like that, when you look at your payslip and you look at your tax and national insurance or social security in the States, it automatically comes out, and we don't have a problem with that. So why can't we automatically take out another 250 quid or £200 a month and just put it in S&P? That's going to benefit us. But this is all psychological, right? Because it's all fixed into our payroll, you know, the money comes out, we're fixed as to what we're used to getting, and we don't want to kind of take out of what we have, our pay slip, basically, the money we get after our tax. But that's the mindset that has to shift, you know, and you have to start thinking about, okay, how can I pay myself? As we've heard the term, a lot of these experts say, pay yourself first, which is right? You earn all this money, look after yourself first, pay yourself first. Even if it's £50 a month, something, just put it in and just let it compound and start young, start really young. You can do it older, you can do it when you're older, but just remember, you just have to put a little more in. Instead of putting £200 a month or dollars a pound, you might have to put $800 for if you've got a short amount of time left for you to retire, if you want to get more money when you retire. And again, a lot of great investors say, you know, you can't beat the market, so just go into an index fund and that will, you know, that kind of mimics the market as they say, and you know, you're thinking long term as well. Now, if you're thinking, oh, that all sounds really good, S&P 500, you know, it seems like stocks and shares that I can do because I don't have to worry about it. And then now you're thinking, oh, well, where do I register? There isn't an actual site called S&P 500. There's brokers, which are the apps. So I use Trading 212 for some individual apps, but shares, but I don't really do individual stocks. To be honest, I'll show you the ones I do. It's basically games companies because I know about video games and, you know, with the AI and everything like that. But otherwise, I don't really invest in what I don't know. And there's also the Vanguard platform. That's the only two I use. Vanguard I use for my daughter's junior ISA, where I've started an S&P 500 there for her a couple of years ago. I was putting 400 a month in, now I put like 250. So that's slowly growing. And that's up until when she's 18, as I'll explain in the video. And then there's a pension fund, which I'll go through with Warner Brothers Discovery that I was on, which I've stopped investing in now. But I haven't been adding to it since, 3 years because I left the company. But I'll show you the power of the power of compounding, and passive income, I guess, but more compounding. Like, you'll see how much money I've made by not even contributing to it. Okay, so let's take a look. So like I said, I had my Warner Brothers Discovery pension, which I don't contribute to, and it's just lying there. And I got my daughter's S&P 500, which I started when she was born. So let's do an example of the S&P 500. So here, you can see it's 12,000. Let's just put 12,026, right? And this is a calculator. It's just an estimate. I'm not a financial advisor, so this isn't accurate or nothing. This is, you know, I'm just an artist, man. So I'm just trying to invest. But let's check this out. 12,600, right, is my starting. Now, this just gives you an idea. So my daughter is 3 now. She's going to be 4. So let's say when she's 18, let's just go to 15 years, right? She's going to be 18 in 15 years. In fact, 15 is fine. And I'm contributing, 400? I would say 250, let's say like $500. It's around that much a month. Okay, and hypothetical. This isn't like real. But what I tend to do here is, instead of 8%, S&P is between 6 to 10%, maybe around that much. So let's say 6%. I always like to keep it low because then I don't get, you know, I keep my expectations low. You know, secret to happiness. Keep your expectations low. So I just put it on 6 and it gives you an idea. If I keep contributing $500 a month to what's already in there, I will be projected to have around about 174,000 by the time she's 18, right? And I would encourage her to keep it and keep going. Obviously, she needs to use it for uni, and this is all for her future, you know, education, and, you know, maybe she wants a new car or something like that, you know. But let's go back here. So if you look at my pension, see, my pension with Warner Brothers is my rate of return. What was the rate of return from 07 April to 07 2023 to 07 2024? It was 17.6%. I remember Peter Lynch used to work. I mentioned his book, One Up on Wall Street. He used to get 30% returns. You know, like, he was really good at investing. I don't know how he did that, but, you know. But for example, let's say it was at 40,000. So last year, I didn't touch this at all. It's like one of these you invest and you forget, right? That's what ETFs, index funds are. It's money that you don't need, you just leave it there. The good thing about my daughter's Vanguard is I can't touch it till 18, you know. This is like, you can see here from 2023 to 2024, that's nearly 6,000. This was 7,000 at once that I made in 1 year. Pure passive income, really. I didn't even do nothing. The amount was in there, 40 grand, and it made 7. Now, 3 days ago, look, it's gone down by 2 grand. So the market's always like that. So I don't care about that because it's long term. You just put the money in, don't even think about it. You got money you can put away for 20 years, like £100, £200 a month. Just keep doing it. Just don't be emotionally attached to this, because that's where people go wrong and they end up selling when it's low and all kinds of, emotional decisions that they make. But for example, let's look at this. Let's just round this up to 40,000. So if I put 40,000 in here and I'm 42, so 55, I'll be able to get that money out of 55. So that's another 13 years, and I'm not contributing nothing to this. Oh man, where's it gone? Zero this out. 6%. All right, let's put 6% here, low. 85,000, which is not bad, right? It's not bad. And normally I'll come back here and I'll be, all right, let me see what 8% is going to be like. So let's go to 8%. 108,000. Now what I might do is, I'll be 55. I could put this up to 15 years. Let's see how that is. So you're looking around similar, right? 126. Now, I don't know how much of this is taxed. I don't know about all that stuff, but I think you can take a certain amount out that's not taxed each time as a lump sum. It depends on I don't know if it depends on the pension fund, because it might just be one law for all. So I'm not really sure about that. But these are just my current investments that I have that I wanted to show you. And this one is really good with Warner Brothers Discovery. It was very good. I called them up and I couldn't contribute because I left the company when we were working for Lego Games. But what this did is that I put in 3% and the company put in 6%. So if you get a company that does that, go for it, because it's free money. It's just free money. I've got a pension in this current company, so when if I do go, then I can let that just compound. Obviously you can't add to it, but then you have private pensions that you can do yourself as well. You can open up a private one like this. But I was going to say the S&P, like if you look at the S&P, I mean the investments in my pension, BlackRock, right, is one of the biggest ones. But if you look here, the asset allocation, most of it is North America, ex-Japanese, European stocks, 10%. Most of it is 64% North America, right? Japan, 5% other stocks, emerging markets and cash, whatever, right? So it's diversity in funds there. Now look at this. This is the top funds basically. So you got Fidelity, you got their funds, Microsoft, Apple, Fidelity. I'm not sure that one is S&P 500. You got, see, it's the Nvidia. We all know about Nvidia working in games, right? We know that name for sure. That's right up there. Amazon, Alphabet, Google, of course, PepsiCo. But most of it, 10% is their fund, I think, the Fidelities. And then you've got 5%, 5% in Apple. 4% in Apple, 4.6, 5.2 in Microsoft, 2.1. The big, so it's more or less like the S&P 500, what you're investing in my pension as well. You look at the funds, they're pretty much similar. And, S&P has Nvidia, as I broke down the funds in just before doing this breakdown here. So yeah, these are things that as artists we think about. So let's get out of this, and I'll explain some more about the gaming stocks and stuff in it, and what Peter Lynch would say. Okay, guys. So this is a part on fear, right? And I had fear too, because I wasn't really aware of what I was doing when I was first looking at these shares and everything. Then that's why, I educated myself first, which is really important. There's great videos out there on experts who talk about this stuff. I'm just sharing with you what I've learned from them. But please, go ahead, check them out too. I'll put links on Peter Lynch's links as well in the description. He's amazing. I've learned most of this. I learned from what he was saying. But what I want to say is, don't get too attached to your money in the stock market. This is where people get confused and they panic buy and they panic sell. So they buy these stocks and then the price goes down and then they sell. They just panic, I lost money. But you need to understand, index funds in particular, is for the long road. Just put your money in. Don't worry about it. Don't worry if it goes down, because you're thinking 10, 20 years down the line, or 5 to 10 years down the line. Ideally, the longer the better. And, that emotional attachment is not healthy. It's not good. You got to think in terms of logic and look at the statistics. What is the market doing? What are people doing? The economy is what you see outside. You see the high street shops closing down, right? Death of the high street. People are the economy. Talk to people. Go outside. what are they going through? Energy prices are going up. They can't afford it. What does that show you? Their wages aren't keeping up with inflation. So everyone's hurting, like these are the kind of signs you look at when you go outside. And then unfortunately it's the inequality as well. When people bet on inequality, they make more money. So it's one of those things. So go outside and talk to people, or just look around the towns, and that the real world will give you an idea of what the economy is like. And also, we talk about panic buying and panic selling. If you keep your money in S&P, it's going to be fine. The only way I guess it's going to affect you is, if there's massive world wars and it's affecting us, everything's closing down. And then by then, your life's in danger and you won't even really give a shit about your money anyway. So that's the only time. Otherwise, these markets are always going up and down, but just remember you're in it for the long road. So for my fellow animators, artists, and everyone else who's interested in investing, this is my take on what I've seen through videos and obviously reading books on the stock market, and how important it is for us, especially, as artists as well. I've seen us artists that we kind of overlook this kind of things, and other people in other industries too, but I'm specifically talking because my friends have mentioned this, and I'm not an expert in this field. And if there's anything you can add, please, happy to be corrected, happy to be, added more information in the comments too, that can help us all. There's loads of experts out there who know this more than me, and that's brilliant, man. If you can add to it, that's fine. I'll learn something new as well. But to summarize, most of these books are talking about the best way is basically long-term index fund, S&P 500 if you can, but there are other funds out there. Do your due diligence and research everything. See what the funds are. As I showed you in Warner Brothers Discovery, most of them are similar funds, apart from, some are like, you have BlackRock and other big, companies like that. But most of it is similar funds, similar companies that they're investing in. All right, guys. So I'm going to finish off. I know there might be people who are not artists who might be watching this channel, but if you are interested in a change of career, or if you're existing artists out there, I have got an awesome course that I've just got out. And so, yeah, if you're interested, only serious people, because this is a serious course getting you from fundamentals of animation all the way up to advanced and getting that show reel ready so you can apply for jobs. And there's a private support group in this as well, where I help give feedback and the community gives feedback. So this is a brand new course I put out. Check it out. You can check out the link in the description. There's a webinar as well. There's a case study. Have a look at that. Take 25 minutes out to have a look at that. If it suits you, that's fine. If not, completely understand. And I appreciate you giving the time to watch the webinar. If you're interested, you could click on the webinar button below, enroll now, and it goes through the whole course and everything in there and what I teach. And yeah, in the meantime, what can I say? Happy animating, happy investing, stay healthy as well, stay consistent, disciplined, and hone in on your skills. Always keep animating or whatever you're doing. And I will see you in the next video.